Taxes in the Dominican Republic were already quite good, but changes just happened that further improved the country's investment climate. Just like that, while taxes are rising worldwide, here they're actually going down. Let's take a closer look at the details. I want to clarify right away that this isn't tax advice, just a legal overview. If you have a specific question, it's always best to consult a local tax expert. Our company has an excellent accountant, and we can set up a meeting if needed. But the general principles remain the same today. The most important new change concerns the tax on profits from real estate sales. Previously, capital gains for individuals were taxed at the standard income tax rate, which could reach 25%. Meaning real estate sales income was added to total annual income and taxed as follows. The Dominican Republic uses a progressive tax scale. I'll roughly convert these figures into US dollars. If your total annual income is under $7,000, there's no tax. Up to $10,500, it's 15% of the difference. And from $10,500 to $15,000, it's 20%. Income over $15,000 is taxed at a rate of 25%. That's the maximum tax in the Dominican Republic. Even if you earn $1 million, you give a quarter to the state. There's one important point regarding real estate. Tax isn't calculated on the total profit, it's indexed for inflation, which reduces the taxable base. So, say you bought something for $200,000 and sold it 10 years later for $500,000. The profit is $300,000, but inflation over those 10 years was 40%. Consequently, you paid 25% capital gains not on $300,000, but only on $220,000. Changes have occurred today. Following the new tax reform, for most individuals, the capital gains tax rate has been reduced to just 10% of profit, which is a 2.5-fold decrease. And this is some of the most significant news. A great change for investors putting money into real estate in the Dominican Republic. You'll agree, this is a very substantial saving, especially for high-end properties or an investment portfolio of several units. That's why analysts consider this reform one of the most positive for the Dominican Republic's real estate market in recent years. Now let's talk about the tax on rental income. There's a very common misconception here. Many people think there's a fixed tax of 10% on the total rental amount. But that's not the case. If the apartment is registered to an individual, there is no separate rental tax. Rental income is treated as standard personal income and taxed according to the progressive scale I just described to you. Depending on how much you earned in total for the year, the tax can range from 0 to 25%. The tax is calculated not from the total rental income, but from the net profit after deducting allowed expenses. What can be deducted? Well, for instance, management fees, repair costs, maintenance, advertising, insurance, utilities, and any other verifiable expenses related to earning income. Let's say your apartment brings in $3,000 a month. Over the year, you received $36,000. But the management company withheld 25% for management. Another portion went toward maintenance, electricity, internet, and, for example, minor repairs. Suppose the total expense was $16,000. Then your net profit is $20,000. Not the entire amount will be taxed at the maximum rate. Income up to $7,000, there is no tax. Up to $10,500 is 15%, and from $10,500 to $15,000 is 20%. Income over $15,000 will be taxed at a rate of 25%. So where does the 10% rental tax that many know about come from? It's very simple. This is not the final tax. If the landlord is a company rather than an individual, it must immediately pay 10% of each rental payment to the state as an advance payment. Then, when filing the annual tax return, the withheld tax is credited. If the actual tax turns out to be less, a refund is issued. If it's more, on the contrary, the difference is paid. Now, one more important point. If the property doesn't have confiteor benefits, an annual tax of 1% of the appraised value applies, which is usually about 20% below market value, and it's only charged on the value exceeding the state-set tax-free minimum, which today is approximately $180,000 US. For example, if you bought a property not covered by the Comforter law for $300,000, its appraised value for taxes will be around $200,000. The first $170,000 or $180,000 are tax exempt. Consequently, you'll need to pay an annual tax of 1% on approximately $20,000, which is $200 a year. But there is one very important exception for new buildings under construction in resort areas that have rental management. They fall under the Comforter law, so you don't have to pay the 3% transfer tax at closing, and this property is also exempt from the annual property tax for 15 years. To sum it up, today the tax system of the Dominican Republic has become significantly more attractive for investors. The most significant change is the reduction of capital gains tax from the previous level, which could reach as high as 25%, down to a new rate of just 10%. Rental income is not taxed at a fixed rate, but rather as ordinary personal income after deducting expenses, which in many cases makes the actual tax burden quite small indeed. And if you buy an apartment in a project with Comforter, you are additionally exempt from property transfer tax, rental income tax, and for 15 years from the annual property tax as well. The Dominican real estate market is very hot today. New changes to further reduce taxes are adding even more fuel to the fire. Everything is changing very quickly here, and today is the perfect time to enter this market while prices are still significantly lower than in other countries of the Caribbean region.